Welcome back to another episode of Fun Friday with, for those in industry, will recognize a very familiar face, the co-founder of Playground plus the co-host of the Best Ever Conference, Gerrit Van Maanen. How are you today, my friend?
I am doing great, Craig. Thanks for having me, man. Excited to be here and good
Yeah,
to see you again. Just saw you a couple weeks ago
absolutely.
in Salt Lake at the conference, and now we get to hang out a little bit on here.
Absolutely. Well, we've kind of known each other for quite some time at this point. The syndication business, for all those who know, is very, very small. And Garrett being, the leader there, one of the co-leaders there running the Best Ever Conference, makes him kind of, a big face of the industry. He probably knows all the people that I know and vice versa. So I thought it'd be fun to kind of talk about your background, your expertise, and kind of the new adventure you're working on here, and also maybe a little Best Ever talk there, if you will. But for those who maybe don't know you, just to kind of start from inception, kind of give us your background story.
Yeah, thanks, Craig. And you're right, it is a small world, and you guys at Lone Star have made a big name for yourselves. You guys do a fantastic job. So excited to be here, and thanks for having me. My background is so I got my start in real estate like a lot of people did, kind of like reading books on real estate. Decided I should do some fix and flip, do some rental properties. Bought my first rental property. It was a duplex, and I was 19. And my brother and I bought that together, scaled that up to a small residential portfolio, sold that off like basically when I was in college. And after college, I joined and got a financial planning and accounting job at FP&A at IBM, so a big Fortune 50 company, and was like, did that for a year and a half. I was like, what am I doing? I need to get back into commercial real estate. And I found a small company called Spartan Investment Group, which was just started. They had acquired 3 self-storage assets at the time, and reached out to those guys and was like, hey, I think I like what you're doing. I really want to be a developer. I want to learn the self-storage business, particularly because I saw a lot of cool things going on there and in that space. And so 2019 joined that company. We scaled that up from, I was one of the first teammates to 150 teammates, 75 self-storage assets. So top 30 owner of self-storage in the United States, went from 3 assets to 75 assets and in 5 years, and did that very quickly. And throughout that time, I did a couple of things. One of the things was we started a construction subsidiary that I was a partner in, and have since sold my interest in that company. But we scaled that subsidiary from 0 to $30 million in revenue, and had 15 employees on that side of the business. And then I also became our director of development after a time in kind of that commercial construction field. I decided I really like the development side of the house, working on entitlements, site selection, finding new stuff. And so I did $100 million worth of self-storage development ground up on the development side of things as well. And then last July, I decided to go out on my own, spread my wings, start my own company. My company is called Playground, and taking what I learned in the self-storage business, but applying that really to the garage condo space. If people are familiar with contractor garages, flex space, garage condo, small bay flex, it's got 100 different names right now. But that's the product type that we're focusing on. 1,000 to 2,000 square foot units that are individually demised and sold individually like condos. So people can actually buy that unit as opposed to renting it like self-storage. And it's a larger format. Water, sewer, plumbing can be used for a wide variety of uses. So we've got a couple development projects on that front in the works. Got some acquisition projects on that front in the works right now as well. And taking what we really liked about self-storage and getting rid of a few things that we didn't like about self-storage, and kind of going into this little new niche, if you will.
Yeah, well, a lot to unpack there. And I love that the product type that you're working on is a lot of it, or is totally different than the kind of garden variety self-storage play and what you kind of get in the syndication space. So when, I think about multifamily, although it's considered an alt, it really should hardly be considered an alt. But when you start getting into self-storage, that's when it's a little bit more maybe fringe in that regard. And then getting into the space you're in right now is definitely what I deem to be, more of the alt. So we'll kind of unpack the new venture at Playground. But switching back to getting in Spartan, how did you find Spartan at that point? Because, it's crazy to think that you got in as early as you did in 2019, because Spartan is kind of a titan there, if you will, with regard to the self-storage space, getting to scale. So what kind of role did you play for the team there, if you kind of unpack your experience on that end?
Yeah, that's a good question, Craig, because what happened is 2019, I heard a podcast, a Bigger Pockets podcast, actually. And Ben Lapidus, who was the CFO at Spartan at the time, he's now my co-founder in Playground and also my co-host at the Best Ever Conference. So he and I have a bunch of verticals together. But he was on the Bigger Pockets podcast, and he crushed it, like did so good on that podcast. And I heard it and was like, oh my goodness, I should go work for these guys. They sound like geniuses. So I was living in a town at the time called Rochester, Minnesota, where IBM's got a big plant. Mayo Clinic is headquartered there. They've got a branch in Scottsdale as well. Um, and and this town was like poised to double at the time. The city had all these growth plans, and I thought there's probably some self-storage opportunities here. So I put together a market research report, actually. So for any of you young people out there who say, hey, I really want to work at Lone Star, I want to work at one of these companies I hear on a podcast, I put together a market research report because I thought if I'm looking for a real estate job anyways, I'm probably going to end up as like a PowerPoint jockey in some way. So I should like flex those skills. I went and found all the self-storage spots in town and went and looked at their rents and surveyed how much demand there was. And I found 2 conversion spots. One was a Shopco that had just went defunct. And the other one was a big industrial building that I thought could be converted into self-storage. And that Shopco, actually, the guys at Spartan were looking at too. So I put this whole thing into a package, sent it to them, and they said, holy cow, like there's a lot of good information here. And we're looking at that Shopco opportunity simultaneously as this like 22-year-old guy has sent it to us. And they thought that was interesting. And they were like, we don't have a job for you right now. But we have like this construction project manager role open. Would you be interested in that? And I was like, I used to build houses. I flipped a house. Like I could do some
I'm that
cabinets.
guy.
Yeah, I'm that guy.
Yeah.
So similar
Yeah.
to like your guys' value add strategies at Lone Star, we were doing value add on self-storage at the time, which is where you buy a junky old facility, paint it, fix it up, get a new fencing, new doors, whatever you need to do to kind of increase rents. And I was running a lot of CapEx on stuff like that across the country. So that's what I originally came in to do. Eventually, we started doing more expansions, and then we started doing more ground ups. And that's how that role kind of evolved over time. But initially it came in just very like, I'll do anything. I ran operations for a short stint while our operations person was out on maternity leave. I was just like sort of doing whatever it took to help get that business up and going. Because at the time it was really just all the founders and a couple other folks. And that's what it took to get that thing moving. And so I was just had a very can-do attitude and was like, let's make it happen. And then we scaled that company very aggressively over the next several years. And that was a good learning experience for me.
Yeah, that's really awesome. And thank you so much for sharing that. That's really awesome on multiple levels, what you did there, because you kind of force yourself into position from your attitude and perspective of, hey, give value and maybe get something back. It doesn't work out all the times, but it certainly did there. But for you, probably not having a specific role coming in, doing operations, doing kind of some acquisition stuff, kind of seeing all those hats was probably, if you look back, I would imagine you might think of it the same way, but the best thing that you could have had happen to you from a career trajectory perspective. Would you say it's a fair assessment?
Yeah, definitely. I mean, right place, right time. Luck always plays a big factor into those things. And then, just getting on a good ship, some elevators go up, some elevators go down. That elevator was going up at the time. And that served me super well. So, got lucky there. And I think for a lot of folks, like there are small companies that are doing that type of thing that are in growth mode all the time. So as folks that are listening start looking around, they say, what should I do? I think that you can go for a lot of pedigree. You could probably join a really big shop, learn how institutional deals get put together, and learn a fraction of those things and be around some really high caliber folks. And that has served a lot of people that I know very well. There's some folks in New York that do 20 years on the street and then they leave and they start a really big fund first go, And there are other folks that say, I want to really learn how to do entrepreneurial deals and how to kind of get my hands around these smaller deals and learn every facet of it. That was definitely where I was like, hey, a 10 or $20 million deal, how do I figure those out? I think that that's something that I could do. I'm probably not going to go raise a fund and have my first deal be like a $300 million mixed use development, but I could probably figure out a 10 or $20 million deal. And so I kind of wanted to go the more entrepreneurial route, which suits a lot of people. And it worked really well for me.
Yeah, it's actually really interesting to mention that. It's really funny. If you're in real estate, you can do the more startup entrepreneurial side or the traditional kind of, work for a big shop, work for an institutional group. And there's no right or wrong. But I think if you look at the side of working at a shop, it's like hitting a single or a double in investment terms, right? But if you look at the entrepreneurial route, you can really hit a grand slam, or maybe you strike out, but then you can go kind of work in any other spot in real estate, right? But that's kind of exactly how I looked at it. I was selling homes as well myself. And then I saw, okay, well, I can always go back to selling homes. That would be a great career, great life. But getting in at Lone Star early enough was, something where that window opens and closes very quickly. That role would be filled at some point. So, the later you get into something, probably the worse of a deal you're going to get. So getting in as early as possible is obviously very valuable. So you served, obviously, 2019 is when you started, and then you recently left. Can you talk to me about the growth process that you experienced and saw there, going from 3 deals, which is crazy to think Spartan was ever at 3 deals because how big you guys are, and then quickly scaling like that? How are you raising money? What was like kind of the capital formation process? Can you kind of open up that curtain a bit?
Yeah, we raised 100% retail capital at Spartan, and building that engine of investor relations is a tough thing to do. You guys have done it super well at Lone Star, and you guys have good programmatic relationships as well. And I think that that is something that we probably could have done slightly better. But ultimately, we raised 100% retail capital, had a big IR team, probably 7 or 8 people on our investor relations that were in charge of, because you guys know it's like not only getting new investors all the time, but servicing your current ones as well and making sure that you're doing a good job of servicing those folks. And that was a takeaway for me as I went to start my new venture, was just, hey, I don't want to have a 7 or 8 person investor relations team. So what types of networks do I need to have with family offices, with fund managers, with smaller institutions who can bring $1 million to $5 million checks pretty reliably, so that we can go and pursue deals, and we can share that pie with a lot of other folks. Ultimately, I didn't want to have large infrastructure, but that's part of scaling as well, is building the infrastructure of your team. And so as you start to say, hey, do we want to be vertically integrated or not? Do we want to have property management in-house? Do we want to have construction in-house? And taking a look at what type of time do I want to spend on leadership skills or leadership development? That's really important. It's tough to have a 20-person property management team or a 20-person construction team if you aren't the type of person who wants to invest in leadership and spend 20 or 30 hours of your week working on leadership instead of working in the business or on the business. So those things make a big difference in terms of like mapping out your future for yourself and kind of where you want to see your life going. But for capital formation, we had all of our debt sourcing in-house and all of our capital raising in-house. And I think that that is something that a lot of people don't try to do. And ultimately, I think that you can have tremendous value from service providers as well. One of the things I like to say is America is coin operated. It's largely pay to play. And so if you're set up for it, you can go find good debt brokers and you pay them and they go find you a good loan. And you can find placement agents and you pay them and they help you find equity or make introductions to you. Alternatively, saying, hey, I don't want to do that. I think that I can hustle and I can figure it out. And I know a lot of banks. And I know a lot of wealthy people and I'm going to go raise all that capital. That can work too, but it can be very time consuming, as you guys know.
Yeah, well, that's a really interesting point there with regard to how you want to have your business. I think a two-man shop, a two-person shop, can really go pretty far, actually. I think farther than one realizes, but that will come by way of only a couple things happening. You're not going to have a ton of in-house investors, meaning you're not going to have a bunch of retail capital, basically high net worth individuals, accredited investors in your deals. It'll likely be someone, maybe you have a equity broker, debt and equity broker, perhaps. Maybe you've got, a programmatic relationship with the family office, something like that. Okay. But the fee breakdown, all said and done, they're going to be, they own the deal. They have all the decision rights. You're basically picking deals, structuring it, putting your risk capital up. So you can do that. But, let's say if those sources shut down, well, then you don't have a business. But versus retail, high net worth individuals, the thing people have to realize is that rich people, rich individuals, are making money at any point of the market cycle. If you're good at sales, if you're a doctor, if you're a lawyer, fees are coming in all the time. You need to place dollars. So I think if you can navigate the retail route, it is the smartest and best way to go. But that takes a very, very large team and human capital effort and perpetual marketing to kind of attribute that, right? Like you always have to be watering that there. But if you can crack that code, you will have an unlimited amount of capital source coming your way to deals. Funny enough, institutional investors, if you were relying on institutions, basically since 2022, you probably haven't raised a single dollar from institutions unless you took a pretty hefty pref coupon, right? As opposed to getting good common equity in deals. So, that's kind of our perspective there is we really do prefer the retail route. Our dream and North Star is to have maybe a couple of, fund managers, capital raisers in our deals. But really just to roll, investor, syndicated, call it, retail investors from deal to deal and fill up a $15 to $20 million capital stack by 15 million at least in-house of dollars. And that will take a long time to get there, probably a market cycle, if you will. But once you get there, you have full control and autonomy of the deal, which is kind of the way to go.
Yeah, you bring up a great point, Craig, which is if you want to, like so many institutions went pencils down after COVID and through COVID and through these interest rate increases. And the folks that were really good with retail capital didn't have to. And they could say, hey, I see buying opportunities. I don't need to be pencils down. I can go make transactions happen. I can create a debt vehicle. I can create an equity vehicle. I can launch new offerings, do recapitalizations, all sorts of things because I've got the flexibility and I've got the control of my deals and of my projects, which is super important. And I think that that gets oftentimes overlooked by the folks that say, no, I just want a $100 million slug from some huge allocator. I want to get $100 million from CalPERS or something like that. And then I'm going to call it a day. I'm going to go just deploy all that money. That's a great business. Like, trust me, I know folks that have done that, and that's a fantastic business to be in. But if you're building a business today, if you're entrepreneurial, if your background isn't, 20 years on Wall Street, you're probably going to have a better time doing retail capital, raising it well, building a great network for yourself. And that network can be like, it's a flywheel. So the more deals you do, the more capital that you can raise, because they say, hey, Craig and Rob and Pete, Kent, those guys treated me fantastic. And then they tell their friends, and then it generates more capital. And ultimately, like, you can kind of build an infinite business that way, which I think is really important and oftentimes overlooked.
Absolutely. I think with the proper reporting, the correct, vertical integrations, keeping investors' dollars and raising someone's dollars and keeping it in is, better than a new investor in our opinion, because if they just stay in there, their money compounds and they add to it. Well, that's just more dollars you're managing on their end. So that's kind of the way we look at the world there holistically from a capital raising perspective. So you were kind of focused on that stuff on Spartan, and then you saw a lot of the growth. Do you think a lot of the deals you did there, or I guess let me just ask, was it a lot of value add opportunity or was it new development? What was like kind of the makeup of deals that you're doing?
Yeah, I would say that our stuff was probably 80% value add and 20% new development. We acquired about $400 million worth of value add stuff. Very few of those properties were just turnkey coupon clipper. Most of them had some form of CapEx or expansions. The expansion plan is really common in the self-storage space, more common than it probably is in multifamily or other assets, where you find a self-storage facility that, 40,000 square feet, but it's on 3 or 5 acres. And you can go and you can add another 40,000 square feet to that property, pretty much double its value, do it relatively inexpensively because utilities have already been brought to that facility. You can do it really quickly because you don't have to go back through zoning or something like that. And so I did a whole bunch of those expansion projects, got pretty good at those. And then the other 20% of what we did was ground up developments, finding sites in markets that we felt were undersupplied, had really strong rents, there were barriers to entry, and going and saying, where do we want to be in this town? How do we find a site there? How can we acquire it? What's our basis going to be for that project? And is that basis going to be competitive with the other competitors who are in that market, such that we can, go find and be competitive on our rents, get this thing leased up, and build a very successful project for our investors. So that was the makeup, about 80-20 between expansions and value add and ground up development.
Would you say when you were working in that specific niche, like when you were bidding on deals, was it mostly syndicators or was it institutional groups? Because I know institutions really started flocking, quite frankly, a little bit away from the multifamily and a little bit more into industrial and self-storage. So with that said, did you see a lot more competition as the years went on to kind of that product type and buyer type?
Yeah, the run up in self storage, how quickly it got institutionalized will probably be studied like 10 years from now or something, because it went from like 2019, just a whole bunch of smaller mom and pop shops. There's 4 publicly traded REITs, 4 or 5 publicly traded self storage REITs. That's it. And then the list like drops off tremendously to the next largest operators. And then there were a whole bunch of just kind of really small groups that were getting their start. And so oftentimes when you're looking at, hey, there's a 4-property portfolio, it's in East Texas, and it's only $8 million or something like that. Well, all the big guys are saying that's way too small. We can't even look at it. We can't even go into those markets. And then they got to the point where every big guy was looking at that saying, how do we roll up? And one of the things that started to happen in self-storage space too was these portfolio economics, which has been around for a long time in multifamily, but was kind of new in self-storage, which is, hey, if we have 10 facilities, they'll trade at a lower cap rate in aggregate than one facility. And so we should go buy 10 of them that are co-located. And now we're selling all 10 of them at a 5.5 cap when we bought all 10 of them at a 7 cap. And so we've got compression there. And that becomes accretive for our investors. Well, that was like all the phenomenon. So we started seeing a lot of folks who said, hey, I'm building a portfolio. I want a concentration of assets in this particular state or region. And that became the hot new play, essentially. And so it did become very institutional very quickly, to the point where, okay, now you see a $10 million deal and all the big names are in there bidding on that particular property, if it's close to a major metro or something like that, plus a whole bunch of regional names, plus a whole bunch of like, good national power players like we were. So I think that will probably be studied because it was like such a fast run up from when no one was looking into the space to everyone was like, we need some self storage exposure. How do we go get it? Who should we back? And lots of money was flocking into the space.
Yeah, I mean, it totally makes sense because you look at self storage and industrial, and I mean, industrial is really more of a true triple net, but a lot of components that are similar to industrial as well as self storage because you're not dealing with toilets, you're not dealing with tenants as much per se in those worlds. I mean, pipes aren't breaking as much in you, I would imagine, in the self storage world. Obviously, industrial, it's a triple net lease, it's a lot less moving parts, it's not as many people coming in and out. I would say it's rare if a tenant will drive or crash a car into the gate or crash a car into the product itself, which you get in some of that workforce housing. Funny enough, which kind of creates a headache and a drag and whatnot. But that said, I mean, I have to imagine you look at these and some of the thesis for this is the expense ratio and how easy it is once you develop the property. Assuming there's not a ton of competition coming nearby. I mean, obviously wages are going up here and there, but the holding costs have to be relatively low. Was that true in your experience there?
Yeah, self storage operates at like a 30% expense ratio, which is pretty good. Depends on the size of your facility, obviously, because if you've got an employee there and that employee is there 40 hours a week, but it's 50,000 square feet versus 60,000 square feet, you can sometimes get a mid 20s, high 20s expense ratio on some facilities as well, which is fantastic ultimately. And we do have some of those same problems that you mentioned, Craig, like, oh, customer ran into a building, customer ran into the gate or whatever. But the beautiful thing about it is nobody lives there. It's not that big of a deal. If a customer runs into your gate on a Saturday evening or something, it probably can wait until Monday morning, sort of thing. Like either you don't have other tenants who are trying to live there, trying to sleep, that deserve peace and quiet enjoyment or whatever. Because ultimately it's like, it's a self storage. You probably are going to be okay. That was one of the things that attracted us to the asset class in the beginning. Is it seemed very easy to manage, it seemed low maintenance. Now, what we found was it's not that easy to manage. It's actually can be somewhat difficult because, like you mentioned, the comparison to industrial, you've got this really ironclad triple net lease in place, sometimes even with a personal guarantee back to the tenant. So not only does the tenant, but the founder of the tenant company is guaranteeing that lease. Self storage has got 30-day leases. That's the beautiful thing about it and the terrible thing about it, because your facility, you can increase revenue overnight. If you say, hey, inflation is 2%, we can raise all the rents 2%. You get a property tax bill, comes back a little bit higher, you can go raise the rents as well, depending on what the competitors are doing. But all those tenants can also leave overnight. That's sort of the downside of self-storage. And that's what we saw some things happening too, where we had fantastic rent growth through COVID and post-COVID. And then once rates started to climb back up, and we saw the REITs can come into your space and the REITs can say, hey, my cost of capital is like nothing. I can drop rents in order to get my occupancy up. And you went from having $20 rents in that market to having $15 rents. And you say, whoa, that just destroyed 25% of our rental value, our gross potential rental income overnight. People are leaving our facility. Why is that? And so you don't have that revenue locked in place. Now, that could fill back up again overnight as well. These things are, you get some good with the bad. And ultimately, I think that became one of the things I realized is when you have a commodity product like a self-storage building or an industrial building or even a multifamily building where you say, most B-class multifamilies are pretty much the same. There's some differentiation between A and A plus or whatever. But when you have a commodity product like a self-storage building or an industrial building, you don't want to have commoditized pricing. And so you can avoid that by saying, well, here's a huge big box, 100,000 square foot industrial building, but now I have an Amazon lease. That locks in the value of this facility because Amazon's going to pay whatever they're going to pay. And it's credit backed by Amazon. Those are good things. But you also could say, I got the self-storage building. It's a commodity and I have no lease in place. My storage unit is just as good as the storage unit across town or across the street. There's no differentiator there. And that became one of the important distinctions is how do I make my, as we were looking at new asset classes too, and I started to look into this garage condo space, is how do I get rid of the commoditized portion of the asset? And that was when I started to realize, well, if I build garage condos and I sell them ultimately, then it's no longer a commoditized asset because, or at least not on the lease value because I'm selling that unit, one transaction, the whole thing is done. That was kind of an important distinction to me. That was a little bit long-winded way of answering that question. But finding a way that you can lock in the value of the facility with the lease.
That makes a lot of sense. No, that's really cool that you mentioned that. And it's funny, it's triggered a thought in my head where I was speaking with someone who is a New York guy and was doing kind of development there. He'd done apartments and whatnot before. And there was a lot of rent control there, right? So New York, interestingly enough, Well, guess what? Rent control to the gills. You can't increase rents a certain amount. Very regulated. But self-storage, you can change the pricing overnight because it is dynamic, right?
Mhm.
So if it goes up and there's big demand, well, hey, it can go up 30 or 40% in a month, but also the downside is the same as well.
Yep, exactly.
Yeah,
So
so let's talk about playground. So you obviously got a very dynamic background and something that's very complementary to your new venture, but it's a little bit different, right? So can you just maybe explain the business product here and how niche your new kind of thing is and kind of how you fell in love with this product type?
yeah, yeah, I am super excited. I could talk about this all day. Um, we're essentially developing what we call garage condos, and what the industry is kind of calling garage condos, I suppose. And ultimately, there's some of these products going on across the United States, probably 100 facilities in total across the U.S. We've got 2 projects going on in Colorado, and we think that this product type kind of initiated in Colorado on the Front Range, sort of early 2000s, late 90s, where it's a big unit, right? It's a self storage unit, basically, 1,000 square foot unit. So typical unit size, probably 25 by 50, something along those lines. About 1,000 square feet, 20 by 45 or so, 900 square feet. It's got plumbed for water and sewer, and it's got power to that particular unit. So with those 3 things, you can put a bathroom in, you could put an office in this space, and it comes basically gray boxed out, 4 walls and some plumbing and some power. And people can make it their own. And that's kind of one of our slogans at Playground as well, is make it your own. Your space, your way. And you can build this thing out into creative office. You can, if you run a small business and you need a place to store your trucks, have your guys meet, keep some equipment there. But you also can use this as basically just an extension of your home. And what we're seeing a lot of the times is, hey, maybe I have a $2 million home, but I don't have room to expand. I got a 2-car garage. I've got an HOA. I need a place to keep some of my toys, and I don't want to move homes or anything like that, but I need extra space, essentially. And so that is the niche that this garage condo product fills. What I love about it is, in the self-storage space, I could build a 60,000 square foot storage building, and at 100 square feet per unit, I've got 600 customers now that I need to find, attract, retain, and cycle through, because some are going to leave, some are going to stay. So you're constantly looking for these locations where I could develop 600 units, service 600 customers. But with our new product type, you build a 60,000 square foot facility at 1,000 or 1,200 square feet per unit, you might have 50 units. And that's 50 people that you need to attract, retain, and sell to. Now we're selling them these units, they're not renting them. So it's a different value proposition to be answered there, a different sales process to take people through. But ultimately, something that I think is very attractive, which is I don't have to service this massive customer base on an ongoing basis. I have to sell a really good product at a fantastic margin that I can service my investors. And then ultimately, we'll set up a condo owners association that operations of that property transitions over to them. And then I, as the sponsor, can get out of that project, and my investors can be out of that project as well. So shorter cycle times, a really niche asset class, and similar kind of fundamentals as self-storage. That's what I drew me to that space, and that's why I love it today.
Well, I have to imagine the development, and thank you for sharing that. I have to imagine the development process and the components to this are very similar, if not the exact same, to self-storage. It's very complementary to what you did before. But as you mentioned, you're selling these units as opposed to renting these units, right? So, you had mentioned the HOA product and kind of type there. Structuring that is interesting. How does that kind of work?
In terms of structuring the condo owners association.
Yeah, exactly. I mean, interestingly enough, because I've obviously know what that would be like for a typical HOA for, homes and stuff. Is it similar to what that would normally be for if you were buying like an apartment or something
Yeah, very
or a
similar.
condo?
Very similar to residential use, where ultimately, as we go through the development process, Craig, we start to identify buyers and start looking for marketing, and looking for who are our end users going to be of this facility. And while we are going through the development process, the entitlement, the construction process, we're selling all along the way, getting pre-sales going. So, for instance, this project of ours in Golden, which will break ground in June, we're already 50% pre-sold on that. We won't deliver that actual building for another 15 months. So that's one of the really exciting things, is our ability to pre-sell, to de-risk the investment early on. And as soon as we get our certificate of occupancy, we'll start the sales process, which is actually transferring certificate of occupancies and putting people in their units and getting people access to their individual units. Once we've basically sold out the project, or reach about 80% sold on that particular project, we will transfer the ownership of this condo owners association. So you have your attorney, they draft a bunch of documents. Everyone that buys a unit is a member of the condo owners association. And then you put a board in place, and Ben and I, we will sit on those boards in the early days, make sure that things get running, decide what the dues need to be in terms of CapEx for maintenance, for utilities, common areas, making sure the cleaning company's there, snow removal, all those things. And we'll make sure that that's all humming. And then about 80% occupancy, we'll transfer the onus of that. The condo owners will elect their own board essentially to be on the condo owners association to make sure that all those things are done on a quarterly and annual basis. The books get done for the property, just various things like that. Not a ton of work, but it's important to get it set up right and to get it kind of kicked off right, and then to maintain a good relationship with those condo owners going forward. If there's a warranty or anything like that, making sure that you're being forthright and that you're getting it done, taking care of them.
Awesome. So then let's talk about the process of going through this, when you kind of get it going. How does it work? So do you basically identify a plot of land and then you start zoning it? What is kind of the study process there? Like what markets are you looking in? Can you talk to me about, the markets you're playing in, where the demand is, and then how you kind of identify and start selling so you can start breaking ground and kind of that whole process?
Yeah. Yeah. To take you through the development cycle a little bit, this is the stuff I love. One, we do market reduction. So we say, what markets do we want to be in? The number one most important thing to us is density of millionaire households. We looked at all the other facilities that have been built in the United States, did copycat matching with them, pulled demographics across all of them, looked at all sorts of things to figure out where do we want to be going forward. And there's markets like Golden, Colorado, Boulder, Colorado, Salt Lake City, Scottsdale, San Diego, Malibu, all these places. And we started looking. Austin, Texas is another one where this product's going to come. The Woodlands outside of Houston. Places where you think, hey, a lot of wealthy people live there. They probably need more space. They probably have big toys, things like that. So we do market reduction. And then after that, we go and we say, where do we want to be in those particular markets? Where will this product fit well with the zoning code? And we start looking at sites, figuring out what we can pay for a site based on what we think we can sell the units for at the end of the day. Go find a site, put that site under contract with what's called a long government approvals period. So we might put a site under contract for 9 months or for a year and say, we'll close on this once we have our permits. And that's pretty typical in land development, not typical in a competitive multifamily auction process or anything like that, but fairly typical in land development where you say, hey, I need 6 months or 9 months to make sure that I can get my site plan approval, my building permits. Once we agree to that, have the site under contract, then we begin all of the design phase, which is getting your civil engineers involved, getting your architect involved, building what you think will be a beautiful building, but also figuring out what that's going to cost. And that's a constant iterative process where you say, okay, we designed it. Now, what's that going to cost? Let's go to our GC. Let's price it. Oh, okay, it's a little bit too expensive. All right, let's see what we could change about that. Oh, can we get more square footage? That would help. All types of things. So you do that a bunch of times until you have basically what you think you're going to go build. Once we know what we're going to build, that's when it's time for us to kind of start turning on that marketing process and saying, hey, we've got a new product. It's coming to this market. Here's where it's going to be priced. Here's where it's located. Here's what amenities we will have. Simultaneously, you're finishing out the permitting process, then going into the construction process. Once we start construction, we convert all those reservations from interested parties into actual PSAs with hard earnest money. And that's one of the great things about this from an LP perspective is we can say, hey, for instance, this project of ours in Golden is 50% pre-reserved and the debt is 50% of that product. So if all of these reservations convert to PSAs, that takes the debt off the entire thing. So for instance, its project is 50 units. The first 25 units pay for all of the debt. The next 13 units return all of the equity. The last 15 units or 12 units are 100% profit. I think that's one of the good things about this condo business model ultimately is you can de-risk it super early on through that pre-sales process that's oftentimes overlooked, but it's kind of one of the little gems of this space.
So how many players are there, if there are any big ones that are doing what you're doing here? Because this is something that no one's really talking about yet. And I have to imagine it's a pretty high barrier of entry to figure out how to make this work for a lot of people. Like this is not something you can just stumble into, right? So do you know how big the space is and how many, exits there are for this kind of sort of thing?
Yeah, great question. We've identified about 5 players who have done more than 5 projects. There are lots of little folks, maybe 100 folks that have done 1 or 2. But there's about 5 groups that have done 5 to 15 projects. I think 15 is about the upper end of that. There's a group that's really dominant in Texas. There's a group that's pretty dominant in Scottsdale, actually. And other than that, it's sort of a whole bunch of smaller things. And so that's one of the things Ben and I are doing is we're focused on scale. We're focused on becoming that number 1 or 2 spot as quickly as we can get there. And we did it with self-storage. So we're going to do it with the garage condo space ultimately. And we're going to say, how do we be super programmatic about this, about being the most sophisticated one in the area, such that if institutional capital does come to the space and they say, hey, we need garage condo exposure, who are the top 5 horses? We want to be in that race, right? And we say, who's the most sophisticated? Who's doing this really well? Well, we want our name to be at the top at Playground. And so that's kind of the thesis of this whole thing. But ultimately, you're right. It's not easy to jump in because the beautiful thing about this, Craig, is that no one's doing it. It's super niche and a lot of people haven't even heard of it. The flip side to that is you go to banks and they say, oh my gosh, this is so cool. I know my neighbor has one of these units. I think these are awesome. But the bank president maybe says, yeah, but we haven't done this before. It's kind of risky. Like, call us on your next one, right? Or the institutional investor says, hey, this is really cool. Let me know how that first one goes. And so that's the beauty and the bad part of being in a niche asset class. Apartments are probably like this 50 years ago, where people said, like, apartment building, I don't know, not outside of New York City. Like, let me know how the next one goes.
You want to manage. Yeah, you want to manage C class or B minus apartments. Ooh, I'm not a slumlord. I don't want to invest in that. Then people realize what's actually, where more people live than not is stuff like that. Not everyone's living in the mansions in Beverly Hills, right?
Yep, exactly. Now today, it's like a huge chunk of our population lives in apartments, but that wasn't the case 50 years ago. Similar thing with this garage condo space. I think 5 years from now, it'll be like, oh yeah, those are awesome. We love those. They're like self-storage. We want to get more exposure to that space. But today, a lot of folks are saying, this is really cool. I want to see how the first couple play out. And that's okay. That's one of the reasons that we're gearing ourselves to be really flexible with the types of capital that we work with, the types of lending institutions that we can work with. Is you've got to navigate those challenges. But that is one of the things about being in a niche space. If you're doing industrial outdoor storage, probably the same thing where they say, yeah, let me know how that first one goes.
Yeah, absolutely. So let's talk about hold period projections roughly. Obviously, every deal is going to have a different makeup, and stuff. But if you were to kind of summarize, if you were just to talk to a family office, if capital raiser, fund manager, LP investor, what is the typical process, soup to nuts, start to end, finish cycle, and projected returns you typically get on something like this?
Yeah, great question. So one of the things that Ben and I do a little bit differently that a lot of other developers don't do is we don't ask our LPs to take any development risk with us. And so all of the earnest money deposits on the land, hundreds of thousands of dollars, and architects, engineers, all those things, we front all of those expenses ourselves up front. And then once we have permits in hand, we've got entitlements in hand. So the deal has now been entitled. We call the LP capital and we say, hey guys, LPs, get on in here. Now that it has been entitled, because every LP's got a story. They say, I don't like development deals. I invested in a development deal. That guy never got the permits. And, 20 years later, I still don't have my money back or something like that. I hear that all the time. I say, well, you shouldn't invest in development deals where there is still development risk on the table. So we take that risk off the table. And then we say, okay, now it's time to start building. We're going to call the capital. We're going to build for 12 months, spend the money essentially on the construction, on the land, and go through that process. We'll build for 12 months. And the way our underwriting, I'll just give you some of the stuff on this deal in Golden that we're doing, Golden, Colorado, is 12 months of construction, 24 months of sales. The entire deal is a 36-month deal. So that assumes we're pre-selling while we're building for 12 months. Then we get our certificate of occupancy. We open up to the public and we start transferring units. And the way we're underwriting it is like we sell 2 units a month, basically, for 2 years. What we're seeing actually happen is we're 50% pre-sold on that Golden project. So very realistically, that could be 12 months of construction, 12 months of sales, or maybe even less than 12 months. Now, I won't market that, obviously, but it could be a 2-year deal, essentially. So the way that that's underwritten is it's a $17 million project in terms of total project cost. We'll sell the entire thing out for $23 million. There's $6 million of profit in the deal, which is really strong returns, obviously. And on a 36-month deal, it's generating a 25 IRR. On a 24-month deal, if we can shorten that sales cycle a little bit, IRR, as you know, Craig, very time sensitive. So if we go the full 36 months, selling 2 per month, that's like a 24.5 IRR. If we sell 10 of them the first day that we open and we sell the rest of them out in 12 months, it's like a freaking 50 IRR or something like that. I wouldn't go throwing around 50 IRR on my marketing materials because I'll get in trouble and people won't believe me anyways. But these deals are very time sensitive. They're fast deals too. That's what we love about them. Is ultimately an environment like this, a lot of folks say, hey, I want to make sure that I get my money back at some point. I don't know about having it out there for 10 years or something anymore. Like I was saying back in 2020, where I was saying, oh, don't even give it back to me. I want you to keep putting it to work. And some folks are saying, hey, give it back to me, and then I'll give it right back to you, Craig. But I do want to make sure that the
Yeah.
deal goes full cycle, that it exits, and then I have the chance to reinvest it.
Yeah, and I have to imagine the return profile of this is not really giving any, cash flow. It's probably all, equity lift. Is that a fair assessment?
100%. No cash flow in these development deals like this. And we're super upfront about that as we say, hey, this is not the asset class. If you're like, I want cash flow for 10 years, man, go talk to my buddy Craig. If you're saying, I want tax depreciation, I want tax benefits, all these things, you don't really get that in condos either. A lot of the times it gets taxed as ordinary income because it's an operating activity, essentially. There's not a building that we put into sale, that we put into service, and then we get to depreciate it, and then we have a depreciation recapture and all this other shit either. So we pretty much like ignore all those things, but we offer super high returns in order to offset the fact that there's not really tax depreciation benefits or anything like that in this particular asset class.
Well, and I think there's almost a misnomer on, to bonus depreciation. If you're able to utilize it a lot, it's amazing. If you've got a big windfall where you've got a lot of stocks that you need to offset or something like that, amazing. But by and large, I think it's a little bit overrated. Sometimes it's a little bit of a sales gimmick and pitch sometimes to always be harping on the tax benefits. Don't just invest in real estate for tax benefit unless you are uber rich and you are one of those unique situations where you've got a massive tax liability because maybe you exited a company, something like that. Very rare, but true by and large, kind of dollar cost averaging your dollars in. Just investing on a tax incentive or just because it's a 1031 exchange, even though that's what we do, it may not serve you best, particularly if maybe you got lucky with a manager who's a little bit year younger, not proven. Don't just roll them from deal to deal. You want to make sure that you have your money grow and you don't lose it along the way by just doing something because you've got a tax clock ticking there. So super important note to mention there. And it's awesome that your deals offer that big lift there essentially in a 3-year hold too. That's a pretty quick recycling of capital. And, to not have to worry about as an LP, pursuit cost, downtime, drag, stuff like that. That's a really big benefit that people get. So then my follow-up question to that whole model would be, are you thinking about doing a model where it's truly more like the traditional self-storage where people would be renting these condo kind of garage spots as opposed to, basically buying the asset itself to kind of offload it?
Yeah, and I just want to say real fast, not a lawyer, not a CPA, consult your attorney on all this stuff. But I completely agree with you, Craig. Like, I think the tax benefits get totally overhyped and blown out of the water. And for every person that thinks tax benefits are worth it in real estate, there's another person that's like, I just got screwed on depreciation recapture, and I didn't know about that when I went into this or whatever. So it's like, invest because you like the deal and because you think that the returns are strong. The benefits, the taxes and stuff, that can be icing on the cake, hopefully. But if it's, for the rare individual, should it be the primary incentive? The other thing that I love about this garage condo model, like you said, it's faster, it's all these things. There's no operational risk. There's no like, are you good at operating a storage or are you good at operating a multifamily? Can you go meet the numbers on your pro forma? We don't operate anything here. We're just selling. So it's like, can we market and sell the units? Well, is the product good enough in this particular location to do that? And then to your actual question, are we going to create some type of for rent model? That is in our business plan going forward. So one of the things that we're doing right now is we're looking for acquisitions as well, so that we can take larger buildings, demise them up into these for rent, flex, contractor garages. And we have basically this big wealth creation development side of the business, and then sort of a steady Eddie cash flow side of the business as well. And we spend a little less time talking about that. We're pursuing smaller deals on there and a lot more personal capital on that side of the house. But we do also have a kind of a long-term plan, which is right now we're looking at 3 to 5 acre sites just for the garage condo stuff. But in the future, we want to start looking for larger 10 to 12 acre sites where we can put some garage condo for sale product in the front and do some for rent product in the rear, and maybe have some IOS out there someday, and maybe have some self-storage on that parcel as well. And kind of creating not necessarily a business park, but these mixed use sort of master planned PUDs.
Storage park. Yeah.
Yeah, yeah. And so we got some storage, we got some garage condos, we've got some flex or small industrial park, and that is sort of in the long term roadmap for us, probably 3 years out before we start doing a couple of those. Right now, we're super focused on doing this thesis, doing it really well, and getting ahead in the leaderboards in terms of how many projects that we've done and the sites that we're finding and how high quality those sites are. So it is on the road.
Yeah. Yeah, it's amazing to stay focused and keep the eye on the ball, but I have to imagine doing the rental side of stuff, once you have more proof of concept, I imagine you're going to be the biggest believer in it. And if your roadmap is 3 to 5 years, my anticipation would be rolling a lot of your promotes and personal dollars into that proof of concept to get that going, to probably be the biggest stake owner and holder of that, as opposed to just selling it, and then also probably having your other investors roll into it as well after they've seen the proof in the pudding and the concept being worked out. Is that a fair assessment?
100%, Craig. Getting cash flow without having cash is a little bit of a misnomer, kind of a fool's errand, I think. And generating lots of wealth basically through these high yield development deals is first and foremost. Taking some of that, rolling it forward, and saying, all right, now we're going to do some for rent stuff. It's probably going to be largely owned. Ben and myself and maybe a couple of really close LPs is probably how we'll do that on the go forward.
Makes sense. So that said, just a little call to action. What equity are you looking for here? Like, what is your avatar, your dream setup? Like, who do you want to be raising from if you could kind of pick and choose? And there could be multiple answers to this, but just so we can set our intentions here, who are you looking for to raise from?
Yeah, great question. So our Golden Garages project is open to investors $100,000 check size and larger. Ultimately, we are kind of building the company to be catered towards $1 million check writers. That could be through fund of funds. That could be through small institutions. We are focused on kind of those $1 million checks. We're getting a lot of traction with that segment as well, who are attracted to the returns and are attracted to the timing of these particular deals. Some of them are individuals. Some of them are small institutions that operate in a very sophisticated model, and some of them are even our fund of funds, but they are kind of on the very sophisticated end of that range, I would say. And yeah, we're enjoying working with those folks. It's small enough that they don't have very much control of the deal, but that we can treat them like, hey, we're raising $6 million for this project. We have 6 LPs in here. So we can meet quarterly. We can have a pretty engaged conversation. We could say, hey, what do you guys think about this particular thing? Okay, we have a $2 million check writer that's a family. And we say, guys, what do you think about this inflation, or these tariffs? Should we go ahead and lock in this contract early? Okay, that's a great idea. Yeah, let's go ahead and do those things. So we'd be a little bit more collaborative in that way with those folks. And it's only enabled by the fact that it's a smaller group. And so we don't have to scale. We don't have to scale our communications to the 1,500 LPs that are in one deal or something like that.
Yeah, makes sense. Very cool. Now, before we wrap up here, just want to figure out and learn how you got so connected to the Best Ever tribe there, and how you and your co-partner there kind of started navigating that. What was that story, if you don't mind me asking?
Yeah.
Like,
So
how did that come about?
we just had our 9th year at Best Ever Conference in Salt Lake City. We'll be back in Salt Lake City February 17th through the 19th, 2026. Get your tickets at besteverconference.com. But the Best Ever Conference has been going on for 9 years now, going on 10 years. And Joe Fairless had the best real estate investing advice ever podcast for a long time. It was like longest running daily real estate podcast,
Yes.
thousands and thousands of episodes every single
Joe
day.
Joe is like yeah, Joe is like a pioneer for those who don't know. Joe was like a pioneer in the syndication space. Like, he was kind of getting into the weeds and super niche down, and it was like kind of called a shot there early on within the
Yeah.
process of syndication for those who don't know.
Yeah, he did. He did. And I think Rob actually is at one point one of his students. So Joe started his coaching, and Ben was one of his students. I believe Rob was. I believe Kent might have been as well. And
Yeah.
ultimately, Ben was one of his students and was like, "How do I learn this syndication thing? I want to buy a multifamily building." And him and Ben became good friends. And through that process, Joe's podcast continued to grow and grow. Ben and Joe continued to become friends. And Ben had this idea. He was like, we should start a conference that's for all the listeners of your podcast. So 9 years ago, they held their first conference. I think probably had 150 attendees or something like that. And now since then, that conference has just grown exponentially. Over 1,000 attendees, lots of really great shops, and lots of groups similar to Lone Star, where they came and they were, had no assets at the first one or something like that. But now look at where you guys are at today. And there's a bunch of success stories like that. The principals of Spartan Investment Group actually met at the Best Ever Conference.
Robin Kent met at BEC.
Okay, that's good. That's what I was thinking, but I couldn't quite remember. So, yeah,
Yeah,
Rob.
no, I appreciate you not going on a limb and just saying something that you may or may not have to be true.
Yeah,
But no, Ken and Rob did the BEC.
yeah, and there's so many great success stories that have come out of Best Ever Conference. So, being at Spartan Investment Group with Ben, he was looking for. He's like, "Hey, you got a lot of energy. You like talking to people. Would you want to help me find speakers for the Best Ever Conference?" I was like, "Hell yeah!" So, Best Ever #4 was my first one where I came in and was looking for speakers, helping be on stage, helping hunt people down. There's so much back end work that goes into a conference. You invite a speaker and you got this awesome speaker who's like runs a huge real estate company. Well, they're busy back. They're chatting with everybody, and they don't know. Hey, man, your session is on stage in like 5 minutes. I need you backstage. I gotta get you mic'd up. And so that was the original. Like, hey, you can be backstage. You're hanging out with these people. You're hanging out with Brandon Turner, asking him about his business, and meeting these people, and like they kind of remember you afterwards. The other great thing about it is a lot of people want to speak at our conference, and I say, well, I use it as a networking tool. I'm like, hey, I think that you're really cool, Mr. Goldman Sachs guy. Let's go ahead and jump on a call real fast. We'll talk about the conference, but then we also usually end up talking about Playground and everything else that we've got going on as well. So I use it as a tool in that capacity, and that's just been one of the best things about being part of that ecosystem of the conference. So tons of fun. Only once a year. I think we might have to start doing it twice a year or something like that, just to get everybody together a little bit more. But we think it's a pretty special space, a room that's good for LPs and for GPs. It's good for figuring out how to scale your business, how to meet new investors, meet bankers, and figure out like, hey, we have it at the beginning of the year on purpose so that people can come and they can say, what's coming this year that I need to be ready for, that I should try to capitalize on in my investing business.
No, I love that. That's super well said. And, I can only attest, I can't say enough. If you guys did a second conference, I'd be pumped. I mean this wholeheartedly. Your guys' conference is the best. Your guys' conference and Raise Fest, for what we are doing at Lone Star Capital are like the two best and really only conferences that I need to be going to, other than the Lone Star Capital Summit that we're hosting on September 15th in New York City. But those are like, to me, the best conferences. I hope you and your partner can make it to that. But in our opinion, like, best ever with what we're looking for is incredible. And it's also one of the only true melting pots of the industry. You've got institutional equity groups, the flagships, the PPRs, the Pearl Marks will be there, right? Then you've got sponsors like us, sponsors like yourself, sponsors like Spartan, ASIM Capital, Rise 48. And then you've got all the service providers. And then you've got a ton of retail investors and capital raising partners. So it's the melting pot of everything all in one. And not every conference has that per se, which is super cool. So I can't advocate enough for BEC. If you're going to go probably only one conference, you would, depending on what you're looking for. If you're an investor, Raise Fest is probably not the fit for you. Maybe if you're a capital raiser, you might want to do Raise Fest or BEC. But if you're, unsure of your business, you want to meet a lot of people, and you're looking to network, I really recommend BEC for those who have not gone. It's also one of the best hotels, the Hyatt there like that in Salt Lake City, well appointed, perfectly, in the middle of everything, is always nice to go to. Best hotel gym in America, as far as I'm concerned.
Yeah, it is a good one, man. I appreciate you saying that, Craig. That means a lot. And we spend a lot of time. We work really hard to say, how do we get some institutions there? How do we get a lot of LPs there? Because if it's all, it can't be all dudes at the dance, right? You need some ladies at the dance too. And so, how do we get LPs? How do we get GPs? And for the GPs, how do we make sure that we have a variety, right? If I'm brand new to this business, I want some people there that I can learn from. And if I'm super experienced, if I'm Joe Fairless, I got $3 billion in assets, but I can bring a great institutional speaker, and even he has something to learn from those people. That's what it's all about for us. And a lot of these folks, 5 years ago, they had 50 million in assets under management, and today, like you guys, you got 700 million in assets. And you're like, I have different problems today than I had 5 years ago, and I need this conference to scale up those things that I'm learning. And that's what keeps them coming back. Ultimately, we don't want people like you to phase out and say, I loved that conference when we were smaller. I don't really need it anymore. We're trying to grow with our audience too. That we spend a lot of time working on that. And so really appreciate you saying such kind things.
Yeah, absolutely. Well, Garrett, we could talk forever. We got to wrap it up here. Where can people find you, reach out to you if they want to learn more about Best Ever, if they want to learn about Playground or just about yourself and getting involved in your ecosystem?
Yeah, you can learn about Best Ever at besteverconference.com. You can learn about Playground at playground.properties. And my email is garrett@playground.properties. My cell phone number is 641-295-2146. I'll bet nobody calls me off that, but I hope someone does.
I hope someone calls him off that. For the listeners who've been here so far, we appreciate you, and we'll see you next week. Thank you for your time, Garrett.
Awesome. Thanks, Craig. See you, man.